Good day. Today we are going to focus on the term prepaid expense. So prepaid expense, it is when the business um, pays an expense of the next financial year. Okay, meaning that, for example, if we're in year 2019, but then the business pays the expense of the year 2020. Okay, so when the business does this, we call this a prepaid expense because we are in this current year, but we are paying for the expense of the next financial year. So we call that a prepaid expense. So a prepaid expense prepaid expense, it's an asset account. So this is a new term in grade 10. Prepaid expense, it's an asset account, meaning that it increases on the debit and decrease on the credit side. Okay, so now because of the matching concept, it is saying that expenses should be recorded in a year that they belong in, even if they have not yet been paid, but they should be recorded in a year that they belong in. Meaning that once the business has paid for an expense of the next financial year, it means that now the business is going against this concept, which is wrong. And now we must correct that. So to correct that, you must decrease the expense account. Okay, let's say for example, we are in year 2020, okay, and then we pay an insurance. We pay it for 400 rand. Okay, so we are told that in this 400 rand, the 100 rand, it belongs in year 2021. So this means that in this 400 rand, there is 100 rand that does not belong in this current year. So what do we do? Because of the matching, it is saying that expenses should be recorded in a year that they belong in. So this 100 rand, it belongs here. So therefore, we must subtract it from this 400 rand, and then we'll be left with 300 rand. So meaning that the insurance in 2020 is 300 rand, and then 2021 is 100 rand. Okay, so that is a prepaid expense. It's an asset account. So let's go do an example. Let's go and do an example. Example, insurance. On 28 February 2011, the accumulated period footings in the general ledger of MN traders of the insurance account total to 16,800. Okay, first thing first. Our year ends on 28 February 2011. So this means that this year started on 1 March 2010, so that it is going to end on 28 February 2011. Remember, a year must be a full 12 months, right? Now, they are saying that the insurance is 16,800. So let's open the insurance account. So we know that the insurance is an expense account, meaning that it increase on the debit and decrease on the credit side. So because it's an expense, so the balance must be on the debit side. So the total is how much? It is 16,800. So this is a balance brought forward. So for the expenses and the incomes, we don't write the balance brought down, we write the balance brought forward. So this is a total. Okay, total, it is 16,800. Okay. Now, what are they saying? This included an amount of 2,400, meaning that in this 16,800, 2.4 is included here. Okay. Now, which was paid on 1 September. So it was paid. Let me draw a timeline. Okay. Let me draw a timeline. So our year starts on 1 March 2010 and then it ends on 28 February 2011. Okay, so they're saying that this was paid on 1 September 2010. So 1 September maybe is going to be maybe here. So it's 1 September 2010. Okay, so this was paid here, this 2,400. Okay, and then they are saying it for 1 year. So they're saying that it was paid on 1 September 2010 for 1 year. It's from 1 September 2010 to 31 August 2011. So they are saying that this 2,400 is for months of 1 September to 31 August 2011. So this is 31 August 2011. So they are saying that this 2.4 is for this period, which is a full year, because they are saying that is for 1 year. So if you can count from 1 September 2010 to 31 August 2011, you can see that this is a full 12 months. Okay, so this 2.4 is from here to here. So now let's check that actually the insurance, it was how much per month divided by 12. So this is going to give you an amount of 200 rand. Let's confirm. There's a calculator here. There's no calculator, okay, but it must be 200 to get 200. Yes, 2.4 divided by 12, it is 200. Yes, so each month is 200 rand, right? But if you can check, after 28 February 2011, from 1 March 2011, this is no longer our financial year. This is the next financial year, because our year right now, it ends on 28 February. So from 1 March 2011 to 31 August, that is a full 6 months. 6 months, so times 200, it is equal to 1,200. Right? So this means that this business, it paid for the insurance of the next financial year. Because remember, for now, our year ends on 28 February. But we paid for the months of the next financial year. So what do we do? Because of the matching, it is saying that expenses should be recorded in a year that they belong in, even if they have not yet been paid. So the business has paid the insurance of 16,800, but then we have paid even for the next financial year. So this means that here in this 16,800, there is a 1.2 that does not belong in this financial year. So what do? We must come and decrease the insurance account, because this 1.2, it does not belong in a year of 28 February 2011. So it does not belong in this year. It does not belong in this year. So now, where do we transfer this to? We transfer it to the new account that keeps the record of the expenses that are paid for the next financial year, which is called the prepaid expense, which is an asset account. Okay, so let's open it. Prepaid expense. So increase on the debit and decrease on the credit side. So we know that if we record something on the credit, it must also be recorded on the debit side, right? So it is GJ. So 28 February 2011. This is coming from the insurance account. So then we are done. Okay. So, but then let's go and show this to the accounting equation. This is a liability, owner's equity, and then asset, and then here we're going to have amount, and then account debited, account credited. Okay, so the account debited here, it is the prepaid expense. It is debited with the 1.2. Prepaid expense. Account credited is the insurance. It is credited by 1.2. Insurance. So the amount is 1,200. So the prepaid expense is debited and it's an asset. So the asset, they increase on the debit. So they have to put a plus sign on the asset. And then the insurance, it is credited, and the insurance is an expense. And we know that the expense, they decreases the owner's equity. Expenses, they decreases the owner's equity. But then this time, the expenses, they are already negative here. They are already decreasing. So this means that under owner's equity, because the expense is already decreasing, meaning that it's going to be negative and negative, which is going to be positive. Then we're done with the accounting equation.